if you're carrying a lot of credit card debt, should you use a HELOC to pay it off or a home equity line of credit? That's the question that we're going to tackle in today's topic. My name is Arjun Dingra. I am a 25-year mortgage veteran and a contributor here for the Mortgage Reports, helping people use resources like this platform to make smarter decisions when it comes to taking out mortgage debt. Now, you've come to the right channel for all things related to making smarter housing decisions. And so let's get into this topic at hand, which is the debt crisis that's facing the United States. Credit card debt hit over $1 trillion for United States consumers last year in 2025. Now, this is the highest in history. And when you take that coupled with the fact that auto loan delinquencies were also getting to levels that were very scary or comparable to the '08 financial crisis, you can see that the consumer is spending way more money than they have and starting to fall behind on paying for those obligations. But while Americans carry a lot of debt, there is a tool that they can use because home equity in the United States is also at an all-time high. So is personal net worth. So while the consumer in the United States is carrying so much debt and starting to fall behind on a lot of that debt, they also are worth more on paper given the hard asset of real estate that they own or their job and the earnings that are attached to it. It seems really incongruent, but the answer to our problem today actually lies there in the middle. And that is being able to use your home's equity, which is considered lazy money, meaning it's kind of growing but not really doing anything aggressive for you. It's just sitting there, being lazy, to wipe out high interest debt that is actually crippling you and slowly making you more broke. Now, I should caution you, while a HELOC sounds and is going to sound throughout the course of this video like an easy fix, it is not a bailout. It is a tool. Because you are using your home's equity, it is going to be incumbent upon you that spending behavior, restraint, and discipline be applied going forward so that you don't end right back up in the same debt trap. I'll get to that part later, but let's first talk about the math. Let's use a general example. For a household that is carrying roughly $40,000 in credit card debt, averaging 24% in interest, those minimum payments for that debt are actually crushing their monthly cash flow. You move that over to a HELOC, which is going to be between 8 and 9%. The interest savings alone is going to be enormous, and the monthly obligation is going to drop significantly. In this example here, you would look at dropping the monthly outflows when you compare the $40,000 at 24 or 25% interest, moving it all over to an 8 or a 9% HELOC by a little over $1,000 a month. That is a lot of money that's being freed up. Money that could be put back towards the principal, paying off the HELOC a little bit faster, investing it aggressively into retirement, or even starting that college fund for your kids. That's the power of debt consolidation when it comes to a HELOC. Now, here's why it works. You end up with a lower rate, which is the obvious part. Again, coming out of something that's in the 20s or the teens in terms of interest rate and moving over to something single digit like 8 or 9%. You also get potential interest-only flexibility because the payments on a HELOC are going to be just interest only, or the interest portion of the payments. If you want to pay down the principal, you have to pay above and beyond. But that interest-only payment, when compared to all this high-interest debt, is actually where the maximum savings is. You can get faster principal reduction if you apply the monthly savings back towards the actual debt itself. So for the example of the credit cards I gave you just a few minutes ago, if you were to take that $1,000 plus or minus in difference and actually pay it down and actually apply it towards the principal balance of the HELOC, you'd actually accelerate that payoff and lower your monthly cost on that HELOC month after month, since it is variable and interest only and based on the debt. So overall, guys, you get a much more simplified payment structure, but only, and I stress this, only if you exert discipline and you stop adding to those actual balances, which means once these debts are paid off or wiped out, you need to stop spending money that you don't have or money that you can't pay it back. And that's the psychological trap that this often leads to, and why, sadly, many Americans, after wiping out all their debt, in a short period of time end up right back into the same debt cycle. You clear $40,000. Now your cards are at zero in terms of a balance and you feel pretty good about yourself. But then lifestyle creeps back. Keeping up with the Joneses, you starting to compare yourself to other people and them spending the money that they're spending on vacations or buying the cars that they're driving, shopping as often as they do, eating out. And so you get right back into the same spending pattern. And now you have a $40,000 HELOC plus $20,000 in new credit card debt. That math, unfortunately, is disastrous, and it's not a trap you want to fall into. So once you have paid things off, once you have consolidated, once you have freed up that cash flow, take a very good hard look at what you're spending money on and eliminating things that are useless, that aren't adding to your future, that aren't adding to your financial goals. I always like to say the money that you're going to spend when it comes to larger expenditures or things where you're pulling money out of an appreciating asset like your house need to also go back into assets or things that are appreciating. If it's going to depreciate, don't buy it, especially with home equity. Now, this is not to say don't have fun or buy things that are going to bring you joy or things that are going to give you pleasure in the short run. For that, you need to use your discretionary income that you actually earn through your job. But when it comes to your home equity, it needs to go into things that are either going to appreciate or, in this case, eliminating things that are bleeding you out so that you can free up that cash flow and do something responsible with it. So here's when I recommend taking out a HELOC. When you have strong income, a short payoff timeline of 2 to 4 years, when there's no more of an ongoing spending problem, and you have intentional cash allocation. Now, if it's just to rearrange the chairs on the Titanic decks, then do not do it. So debt consolidation, guys, as I stressed earlier, really, truly only works when there's strong behavior change attached to it. Otherwise, it's just debt relocation. You're paying it off here to move it over here, only to re-rack it up back over here. And now the problem is exacerbated. Now, this isn't anyone's fault. Just to close this out, this is a big part of society and consumer culture because people always want to spend money on something that they want right now, but aren't necessarily thinking about the future or being practical as to whether or not it makes sense to buy now, or could you truly even afford it right now? And because credit is so readily available and accessible, buy now, pay for it later, put it on layaway, take it home today. These are the expressions and the phrases that we hear, but all they're doing is locking us into higher interest payments back to them, in which case they're actually going to make way more money, whoever it is that gave this to us, than had you just paid for it in cash right then or there. So don't fall into that actual trap, because it's that trap that keeps people in the middle class stuck in the middle class, people in the lower class stuck there and never able to elevate to the middle class, and ultimately more Americans broke. Break the cycle, exert some discipline, take a good hard look in the mirror, control spending, live within your means, use your home equity wisely, and you'll start making better decisions that will propel you and your family's wealth higher into the future. Thanks for listening, guys, on this episode, and we'll catch you on the next one.